Here in this video, we're going to tackle the budget analysis section. Good news, this is the last section of the budget. So if you've been sticking with us through all the videos, congratulations, and you're on the last screen. This screen's going to be important. There's going to be some good information that comes back to you from the screen. You're not going to have to do a whole lot on it, but it's nice to understand what these metrics are telling you because they're really important metrics for your business. So let's take a look at that sample screen now. Here I'm looking at my budget and I'm going to go down to the analysis tab to see this information that we're going to talk about. The analysis tab is going to show you a couple of key pieces of information. First of all, where's my revenue going? All this does is put a pie graph of your total revenue and then show you where it's going, what's left over for profit, what's getting spent on wages, equipment, materials, subs, and overhead. It's a handy graph with some really handy percentages that you can use to compare to something like QuickBooks at the end of the year. Next up on the right-hand side, we've got this thing called revenue per man hour. You're going to see a dollar value here. This is not your charge out rate per man hour. Lots of people get confused about that when they call in saying, I can't get that kind of number per hour. That's not what that number is. What that number is your total sales goal divided by the number of man hours in your field labor budget minus this percentage of unbillable hours right here. So what we're saying here is, if you want to hit $1 million in sales, at least in my budget, that's what I'm gunning for, I only have 14,090 crew hours to generate that much sales. But we all have to remember that not all these hours are going to be productive. Some of them are going to be drive time and shop time and washing trucks and training. So that's why we subtract this percentage here, and you're in control of that percentage. You can tell us approximately what percentage is unbillable time. And what then we'll calculate for you is your revenue per man hour. That is how much total revenue each person needs to generate per man, per hour in order to hit your sales goal. So what does revenue per hour mean? Well, if you're charging labor, that's one thing, and that this is not your rate per labor hour. What this means is you're going to generate some revenue from your labor rate per hour. Maybe it's $40 or $50 an hour per person for your crew. But on top of that, they're going to install materials in those hours. They're going to use equipment in those hours. You're going to recover overhead in those hours and profit. And what it's saying here is each hour needs to generate $88.72 of revenue. So if I had a 3-person crew, I could calculate 3 people times $88.72 an hour is how much revenue we need to generate per job hour for a whole crew in order to be profitable. Now, the really handy thing is what it'll do is take every estimate you generate. It'll look at the estimate selling price and divide that estimate price by the man hours on that estimate. That'll tell you each estimate's revenue per hour. The reason this number is so important is that before you even set foot on a job, it's going to look at what's your estimated revenue per hour and what's your budgeted revenue per hour. If your estimate's revenue per hour is lower than your budget, then that estimate or that job is not helping you hit your sales goal. In fact, if you take too many of those jobs, you will not hit your sales goal. On the flip side, if you get an estimate or a job where its revenue per hour is more than your budgeted revenue per hour, that estimate is helping you hit your sales goal, or that job is, as long as you get it done on time. And the more jobs we get with a higher revenue per hour, the more likely we are to beat our sales goal. And why that's so important is the more I beat the sales goal by without changing my overhead, the more money there'll be left in our business for net profit, for rewards of our staff, etc. Going down the list on the left-hand side, you're also going to see one called capacity or efficiency. And it's asking you for an average charge out rate per hour. Now, here's where you're going to enter your average billing rate per hour. So if you charge on average $50 an hour, that's what you're going to put in there. Or maybe you charge $36 an hour. That's what you're going to put in there. Oftentimes, different crews have different charge out rates. So then what we need you to do is take an average. Once you get your average, we will calculate your company capacity. Now, how's it going to do that? So first, what is your company capacity? Well, those are the sales that you should be doing given the expenses that we have. And how do we know that? Well, what it does is take your labor and multiplies it by this charge out rate. It takes your equipment and adds your company's overhead and profit. It adds your material costs and your company's overhead and profit. And same thing with subcontracting. Add all those together, and that's how much revenue you should generate based on the costs you've budgeted for. Now, of course, your sales goal is how much revenue you think you'll generate. So the difference between how much you should generate and what you think you'll generate is how efficient your company is. In this case, I'm generating 88.1% of the revenue that we should be generating with a sales goal of $1 million. And 88.1 is a good number. If you're at 85 to 90, you're almost certainly going to be profitable. The problem with many landscape companies is that they're down in the mid 70s. And actually, it's hard to be profitable. So if you're struggling to make your landscape company profitable, but your efficiency is telling you you're in between 70 and 80%, there's one of your reasons. Based on the costs you're incurring, you should be generating more revenue. So why wouldn't you be? Estimating problems in that we're not estimating enough material cost to jobs. Could also be the same with subs, but generally those are minor. The biggest problem is often employee productivity or field labor productivity, that we just have simply too many man hours for the sales that we're generating. We need to generate more revenue per man hour. How do we do that? Getting more productive, making less mistakes, getting jobs done on time, charging the right amount per hour, being efficient every single day. These are all the ways that are going to increase your company's efficiency and get you closer to your capacity. So if your capacity and your sales forecasts are very different, it should tell you you need to become a more productive company, and you should work on that. Finally, we look at something called budget throughput. And budget throughput's a little bit of an interesting number. It is your sales goal minus materials and rentals and sub costs. So what this number is basically the revenue that your company has left after it pays off all its vendors. So you take all your sales, you pay all your vendors off, and whatever you have left is enough to pay for your field labor, your equipment, and your overhead. Your throughput per hour is simply your budget throughput divided by the number of man hours that you put in your field labor budget. And again, that's how much money your jobs should generate per person per hour in throughput. That is sales minus materials, rentals, and subs in order for you to hit your sales goal. This number isn't going to mean a whole lot for you right now, so don't overthink it. But when we get to estimating, it's going to be a really cool number because it'll look at how much revenue per hour your crews are doing after your vendors are paid. Finally, the analysis screen will give you some warnings if you're off. My budget's pretty accurate, so I don't get any warnings. But let's see what happens when we change something around. I'm simply going to go to the field labor budget, and I'm going to say, we're going to do the same sales, but I have 7 landscape foremen. Let's go back to the analysis screen. Immediately now I get a warning. It says your labor ratio is higher than average. Your ratio is 48%. The recommended is 25.6. So it's looking here and saying your labor ratio, your spend on labor is a lot higher than the industry average. And this is something that's either a mistake or you need to fix. So it's going to ask you some questions. Double check your payroll summary. Make sure you've got the correct number of field staff. Make sure you got the right amount of hours. Look at your hours per year and your overtime hours. Did you do work for cash? Maybe you're counting the expenses but not counting the revenue. Do your jobs often take longer than estimated? It's going to go through a bunch of questions here to help you get your numbers on track. Now, the analysis isn't necessarily the truth. We can only look at averages and compare your company's numbers to the averages. Your company's numbers might be right, and you might be safe to ignore our analysis. The analysis tool is just there to help companies who are struggling pinpoint some of those areas that look significantly different than the industry average. And then those are typically the areas you need to work on. The best advice you can get, obviously, is to consult a financial professional. Let them have a look at your numbers and identify some shortcomings. When you're all done on the analysis screen, you can save your budget right here. And if your budget isn't active yet, there'll be a new button here that says Activate. And by clicking the Activate button, your budget will be ready to use for estimating. It's an important step before you can use it for estimating. Thanks for joining us through these budgeting videos. If you have any questions, last time we'll announce this on this set. You've got live chat. You've got your golmn.com/help, where we'll have tons of frequently answered questions. And you've got advice at golmn.com. Reach out to us. We'll connect with you one-on-one, go through your questions individually, and help you tackle it, because it's so important to have your budget set up correctly, not only for LMN, but for your business in general. Thanks, and we'll talk to you soon.